So we gave it one extra Berkeley minute. We have about 15 people that have RSVP'd that are not showing up. So when they come in, let's make some serious fun of them for being late. I hear that's also a Berkeley tradition. Who went to Cal? Wow. Good. I'm among peers. Except for you. So we do these live events twice a year. We do one in January. We do another one in July. So there's two reasons we do these events. 10 years ago, we started the firm. I made a commitment to about 7 clients at the time that we would focus more on planning and education. And so this is sort of the continued fulfillment of that second commitment of educating folks and continuing to communicate with people. Also, the only way that we're successful is we do the right things. And the only way we can do that is if we ignore the media. And so this is fodder to battle off what's ever going on in the, on NPR that you heard today about whatever's going to fall apart or whatever's too exciting in the dot-com era or real estate in 2005. So this is, oftentimes, it's a guidance away from other stuff that you hear because no one has any clue what happens next, right? That's the big illusion, is that we have some kind of control. And we don't. However, and I'll show you a slide today that will give us kind of a history that should embolden faith and belief in the future. We don't know what's going to happen, but we should be able to have a belief in that. Now that you've seen this, you can tell what the market did or what the S&P 500 did through June 30th. But just think back till 4 seconds ago before you saw this. Did you actually think that that's what the market had done so far this year? Why not? I do this and I see this every day, and it still is like, wow, if you read a paper or listened to a radio station or watched TV, you would never think the market was up kind of an average amount so far this year, given what's happened, right? But it is. That's just one more piece of information you should log away, as maybe don't always listen to what you hear, listen to, read. Foreign stocks up 1.1, and you can kind of see, Spain is off huge, and so is most of Europe. And so for foreign stocks to be up 1.1, there were some things that were up, right? Commodities down, oil was down pretty big. January, we talked a lot about the 10-year Treasury yield. And we said in January that couldn't go any lower. Here we are, proven wrong, it can go lower. We didn't until actually probably May remove our exposure to Treasuries. But in April, May of this year, we've removed exposure to Treasuries completely. Because there was a FINRA did a study, and 79% of investors do not understand the relationship between the rate and the value of the bond. What happens when rates go up? We have one person that gave me a signal, bonds go down. It's a mathematical relationship. If you buy a 10-year Treasury today, it's going to pay you 1.5% plus or minus 0.1%, right? And if interest rates go up 1%, that bond will go down 9% in value. At some point, between now and 10 years from now, interest rates are going to go up 1%. They have to, right? So that is a place that's not giving us any compensation and is enormous risk. And I'm going to say it again, it can't go down any lower, but we'll wait and see. All right. So this is the one big headline over and over and over and over and over. And I'm going to tell a little story. Who's lived in a condo? Now or previously? Oh, come on. There's more people who live in condos. I lived in a condo when I came out here. So you remember your HOA dues. So the idea of an HOA dues is you got 100 units in this condo. Everyone pays $200 a month. And then if something goes wrong, elevator breaks, street needs paving, place needs painting, needs a new roof, the condo association either has the capital for it or can borrow, because they have the income stream, to fix that problem. This is what's missing in Europe. There is no common fund that can help somebody that's hurting, right? So Europe needs to be the United States of Europe in their own version. They need to have fiscal unity. The only way their problems are resolved, it's two possibilities: fiscal union or break apart. Only options. It's a fantasy, anything else they're talking about. So this is not over, and we're going to get a little deeper here in just a sec. So this is the beginning of the euro, right here. See that line? That's 1999, early 1999, and you can kind of see what Portugal, Ireland, Spain, Italy, France, and Germany paid for interest rates. Up here, that's a 12, that's a 14, that's an 8, that's a 6, okay? So there was a wide range of different rates. So this is the world saying, we're only going to lend to you if you pay us 14%. Now, it's odd that right here, upon the introduction of the euro, those people that had to pay 14% now get 4 or 5%. Because remember, there's no fiscal union, right? Germany is not on the hook for Portugal's debt. And the more you read and the more you listen to this, the more you understand that Germany will never be on the hook unless they have sovereignty over Portugal's spending. They're not going to bail Portugal out to the extent that everyone's asking them to. And in 1 second, we'll see why that's a big problem. So the story I tell here is has anyone been to Berkeley Family Camp? We talked about it earlier today. Berkeley Family Camp. So this is my second year. I went last Thursday, Friday, Saturday, Sunday. This is what happens at Berkeley Family Camp. This is the coolest thing about Berkeley Family Camp. It's also the most difficult thing. My kids, they have absolute freedom. Now you walk in the dining hall at Berkeley Family Camp. Right when you walk in, there's cabinets, and the cabinets are filled with cereal. Some are Cheerios, Corn Flakes, Rice Krispies. Others are Fruit Loops, Trix, and the sugared. What's the one with the marshmallows in it? Lucky Charms, right? Lucky Charms. So my son loved Lucky Charms, my daughter loved Fruit Loops. So you go, and every time they walk by, they can go in and then get out as much sweet cereal as they want. That's here. Before, at home, we say, no, you can't have sweet cereal. You're not allowed. You don't have it. It doesn't exist in the house. Can I have candy? No. Can I have this? No. How about ice cream? No. So this is no. It's a huge pain in their butts. They don't get what they want without paying a high rate of interest, which is behavior. At family camp, they get whatever they want whenever they want, right? But you bring them home and they're angry because they don't get it anymore. And that's what this is. So now they all have to pay the same rate of interest that they had to pay before. And this entire period of time in the middle, they've borrowed more and more and more and more because their debt service was so low and so inexpensive. And now we're saying, guess what? All that debt that you borrowed is now going to be at a higher rate of interest. Big problem. Okay. But here's the really big problem. How many folks have heard me say, it's not the bus you see that gets you, it's the bus you don't see that gets you, right? Okay. So there's a guy named John Malden, and I read his stuff every week. He's a pessimist, he's negative, he's painful to listen to and read. Very accurate, very astute, very bright guy. And he took all 17 countries, and he built a graph of each of the 17 countries. And the graph was debt to GDP given current policy, austerity light, and austerity heavy. So what happens if we crank up taxes and reduce spending, austerity heavy? What happens if we raise a little taxes and reduce spending a little bit, austerity light, or current policy? Which country on this list, Germany, France, Italy, Spain, Netherlands, Belgium, Austria, Greece, Finland, Portugal, Ireland, Slovakia, Luxembourg, Slovenia, Cyprus, Estonia, and Malta, is the most like Greece in projected debt to GDP? France. That's the bus we don't see, France. So in 20 years, in 10 years, in 20 years, in 30 years, in 40 years, the projections are almost identical for France as they are to Greece. And remember, Greece has already been bailed out. Greece is already completely insolvent. So what happened a year, Holland in France gets elected. What's the first thing he did? He increased benefits, early retirement age. He raised costs for the government, right? Everywhere else in Europe is going another way because they have to go another way. So my assumption, and this is, I could totally be wrong on this, by the end of this year, if not by the end of the summer, you see France's debt get downgraded. When that happens, Germany has to distance itself from France. Because right now, Germany and France they're together. They're trying to solve this problem. And so we're going to talk more about what that means and how big a deal that is. But first, because I think this is heavy, painful stuff, we're going to do something funny.
Your name is Roger, yes?
Roger.
Ah, that's your name.
Roger.
Good. And what do you do, Roger?
I'm a financial consultant.
Ah, financial consultant, eh?
Roger,
yeah,
yes.
Terrific. And Roger, how's business at the moment?
Not bad, thank you. Been a bit quiet lately.
How do you mean lately?
Since the war, been a bit quiet.
Fair enough. Okay, Roger, your special subject tonight is the economies of the European community. Your time starts now. Best of luck.
Thank you.
How much does Greece owe, Roger?
$367 billion.
Correct. And who do they owe it to?
Mostly to the other European economies.
Correct. How much does Ireland owe?
865 billion.
Correct. And who do they owe it to?
Other European economies, mostly.
Correct. How much do Spain and Italy owe?
$1 trillion each.
Correct. Who to?
Mainly France, Britain and Germany.
Correct. And how are Germany, France and Britain going, Roger?
Well, they're struggling a bit, aren't they?
Correct. Why?
Because they've lent all these vast amounts of money to other European economies that can't possibly pay them back.
Correct. So what are they going to do?
They're going to have to bail them out.
Correct. Where are they getting the money to do that, Roger?
That's a good question. I don't know the answer to that one.
How much does Portugal owe?
Hang on a minute. What was the answer to that earlier question?
Just keep answering the questions, Roger. Where is Portugal going to get the money it owes to Germany if Germany can't get back the money that it lent to Italy?
Just a minute. What was the answer to the previous question? The question was, how can broke economies lend money to other broke economies who haven't got any money because they can't pay back the money the broke economy lent to the other broke economy and shouldn't have lent it to them in the first place because the broke economy can't pay it back?
You're wasting very valuable time, Roger. How much money does Spain owe to Italy?
$41 billion, but where are they going to get it?
Correct. What does Italy owe to Spain?
$27 billion, but they haven't got it. They're broke.
Correct. How can they pay each other if neither of them has any money?
They're going to get a bailout, aren't they?
Correct. And where's the money coming from for the bailout?
That's what I'm asking you.
Correct. Why are people selling the European currency and buying the US dollar?
Because the US economy is so much stronger than the European economy.
Correct. Why is that, Roger?
Because it's owned by China.
Correct. And very well done. And after that round, you've lost $1 million.
I've lost $1 million. I thought you said well done.
Yes, well done. You've only lost $1 million. That's an extraordinary performance, Roger.
I've only lost $1 million.
Very well done.
And that's quite good, is it?
Oh, it's excellent.
Sell everything immediately. Quickly.
All right. So that's a little who's on first financial humor, right? So, but that, I mean, that's totally accurate, right? The idea that all these countries owe each other, that's the big problem. And that's actually Spain's big problem right now, is because when you borrowed through the last 10, 15 years, when a bank loaned money to a country, when it comes to their capital ratios, it was 100% guaranteed. But there was no guarantee on it. So it went to their highest tier of capital, and now it's not worth what it was once worth. So the banks in Europe are largely insolvent across Europe. The United States banks have in the last 2-3 years completely pared down their exposure to our vast benefit. It's excellent what they've done. They still have some exposure, but not a lot of exposure. So when you look at this, what's kind of this is the U.S. growth. This is since this is 2008, 9, 10, 11 in the last quarter of this year. So if you listen to the media, what the media says is it's subpar growth, and that's all they focus on, and it's absolutely true. But this is what I think it is. It's consistent low growth. A little different flavor, right? Good low growth. And that's actually a positive. It's consistent. It's something we can rely on. But it comes from something, and we're going to look at what that is here in just a second. However, so this line right here, I know it's tough to see, that is current 2007 employment recovery. So notice the difference in terms of time. This is months that have passed since the beginning of the problem. This is the last one. This is the one before that. So there's a trend within the trend. And so we've actually said for 2 years, 3 years, that employment recovery this time is going to be a long, 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 painful process. Why? What part of the economy is just humming, that's doing really, really well? Technology. Right? So why is that? Because people generally, or companies generally, when they can buy something, a machine that'll do what a person did before, they're opting for the machine. Even if it's one machine and needs someone to run it, it replaces 15 people's jobs because it's a less expensive way to go. What's the benefit of that to us? Excuse me? Productivity's up, but to us as consumers, what's the benefit? Prices go down, right. So So we could say, well, maybe we should make everyone farm their own vegetables again, because that will give everyone more jobs. But that would actually hurt the economy. So there's a benefit to this problem. And the resolution just takes a long, long, long time for this. So I speak at Cal occasionally, and the story I tell at Cal is, first, there's something embedded in this. If you have a college degree, have any idea what the unemployment rate is for someone with a college degree? 3.9. It's 4%, which is, it's not equal to, but it's dang close to what it was in the dot-com. I mean, it's really, really low. The problem is, if you have no high school diploma, your unemployment rate is 13, 14%. And between there, it's 8. So education, 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 education is critical. But if we're educated, if our populace is educated, there are jobs to be filled. In fact, many, many Fortune 500 companies say that they got to bring people in to hire. So that education and what we're failing is there, not on the economy, not on the production, not in manufacturing. It's in the education of our populace. Okay. Still missing 4.6 million jobs. So if that's true, how come retail spending is an all-time high? How is that possible? We're paying off debt at the same time. Retail spending is an all-time high. We're paying off debt. They're paying more for those jobs? I have no idea. That's a good explanation.